me first get Mr. Sriram in, the banker. The governor all but exhorted you to cut rates, Mr. Sriram. He kept hinting that it is for the owner and the board to do it. Almost a direct hint to the government that they should be giving you directions to cut rates. Anyway, be that as it may, what will be your next action? When do you see base rates falling at all for you or for the system?
You see, policy transmission will happen, and it does happen, and the only thing is that unlike the transmission to the markets, it takes some time. Like for example, we have a liability book of almost 14 lakh crores, and for any impact to happen on that on the basis of transmission, it takes some time. The other hand is that there are two ways in which the transmission happens. One is that in terms of spread over base rate, and the other is in terms of the base rate itself. Now, even before the January 15th rate cut, there has been transmission by way of spreads over base rate to various sectors. And I'm sure this will be a matter of time when we start to again look at it as a bank as a whole, sit and discuss in our alcos and try and see as to what is the best way forward.
So within the quarter, you think?
I can't target a particular date, but I'm sure the intent is there, and we will be driven by our figures within the bank.
Okay, just hold on to that thought, sir. The markets have fallen about 150 points, and I think the Nifty is down 40 points. So why don't I go across to Mr. Naren of ICICI Prudential. Naren, how long is this disappointment? 40 points is not a great deal. So you think this is just one day's work for the market and it will go on expecting that the governor will cut maybe in March or April? Or do you think this is going to be a slightly hawkish kind of stance according to the market? How are you reading it as a market man?
I think India has been one of the best performing markets in the world over the last few months, and that was certainly because of the rate cut given on Jan 15. So I think the next event from an equity market point of view is certainly the budget, and what the budget can do in terms of moving forward the growth dynamics is, I think, going to be much more important over the next few months. I think market will shrug off the fact that today there was no rate cut, and what we would like to see is a much bigger increase in financial savings over the course of the next few months. If that were to happen, I think we would actually be well prepared. And from an equity market point of view, we hope that this crude move which has happened in the last 2 days, taking crude to 55, doesn't keep carrying on and go back to the 80 to 100 range. If it were to stop at around 60, we would think it is optimal that there won't be a problem in the oil exporting country and the oil importing countries benefit. I think these are going to be more important issues for the equity market over the next few months, because India has been one of the best performing markets in the world.
Okay. Now, I take your point that there are other worries for the market, budget and oil. But how are you reading the governor's press conference itself today from a stock investor's point of view? As Taimur Beg pointed out, when I asked him specifically whether you want a 2 percentage point or a 1.5 percentage point difference between the policy rate and the inflation rate, he pointed out to Rangarajan. I mean, he seemed to veer that I want at least a 2 percentage point difference. Looking at all this, are you seeing rapid rate cuts? As a stock investor, does that bother you?
See, I think clearly, if you see, I think there's a fair amount of cushion that the central bank has at this point of time. And what we felt was the way the Coal India issue happened, and it does contribute to fiscal consolidation. So maybe the equity market ahead of the event was looking at the fact that the Coal India issue meant fiscal consolidation, and possibly we were all thinking that there was scope for a rate cut based on the Coal India issue. So what we think is that I think the fiscal consolidation part of it is happening quietly, and over a period of time, I think the market will realize that there is scope for huge number of rate cuts as the Reserve Bank governor pointed out, you have to actually solve the supply side issues in areas like vegetables, because these are the things which are going to drag the dynamics of CPI in the near term. If you see the global situation, it's one of deflation. So I think if we are able to get the food supply chain right, I think we are in a phase where we can see interest rates go down much more significantly. But I guess the Reserve Bank governor wants to see the impact of what is happening on the food side. And if they are able to get the supply side there, we are going to see much more rate cuts than what the market currently believes.
Fair enough. Taimur, before I let you go, and I know you're in a hurry, what's your trajectory of inflation and what's your trajectory of the rupee going by the manner in which the Reserve Bank seems to be actually resisting foreign flows?
Well, I wouldn't characterize the Reserve Bank as resisting for inflows, but I do think that they will not welcome a sharply appreciating exchange rate. I think that is clear. And as you also heard from Urjit Patel, that with the Fed normalization as the major backdrop, and all sorts of central bank moves going around the world, you cannot somewhat be in the middle. You either have to sort of go with the Fed or try to resist the Fed all the way. I think in this particular case against the dollar, it's very hard for me to see the rupee strengthening further. It will be in the 62-63 range for the rest of the year in my view. And if you see an investment cycle picking up, we will also see the trade deficit worsen and the supply-demand of dollar issue will become a little more tighter. So I don't think the rupee has further grounds to gain. Stable, perhaps slight depreciation trend. That's my view. As far as inflation is concerned, clearly we are not going to see major disinflation on a year-on-year basis in the next couple of months. The base effect is a bit adverse. But then we'll head toward 5%, perhaps even below 5%, but not a whole lot more. I still think 5-ish is the best case scenario. We're not going to go significantly below that on a sustained basis.
All right. Thanks a lot, Taimur, for joining us. Similar questions to you, sir. Sonal, what were your key takeaways from the press conference in terms of the timing of the next cut and the number of cuts hereafter?
A bit surprised. I mean, obviously, no action was sort of well expected given we really did not get any incremental news in the last 15 days. But a bit surprised by no change to the Jan 16 CPI forecast because clearly the underlying inflation trend is already closer to 5%. So if the RBI is sticking to Jan 16 inflation projections still at 6%, then perhaps, they are waiting for more clarity once the new CPI index comes, on 12th Feb to take a final call, or they expect, the disinflation to broadly come to an end and inflation to actually start to stabilize or go up going forward. Otherwise, there was no reason why the inflation forecast shouldn't have been cut. So a bit surprised by that. And second, on the intermeeting cut, the comment that the governor made is that that's always on the table, but they would try to stick as much as possible to the scheduled policy meetings. So I think, the expectation of a March cut post-budget also may not materialize because if the RBI keeps moving intermeeting, then the sanctity of scheduled policy meetings basically gets diluted. So the April meeting actually will be quite important. We'll have more numbers on the GDP side. We'll have the budget. We'll know how the change in the CPI base affects the underlying inflationary cycle. And we should actually also have, more importantly, clarity on the new monetary policy framework. The Monetary Policy Committee moving to the 4% inflation target. So all those things actually will become more important. Our call at this stage is for a cut at the April policy, post which we are expecting the RBI to stay on hold.
All right. Shilpa Kumar, what has been your key takeaway? Like Sonal mentioned, the governor has not even lowered the January 2016 inflation forecast, remains at 6%. So what are you factoring in, and how do you see, therefore, bond yields moving here on? Do you think they're going to remain at the 7.75 for a goodish bit?
Yeah, Lata, I think, it's good to kind of take a slight bird's eye view of the situation. I think you have to put the policy in the context of what's happening overall. I think if you look at the last 1 year, the way India has moved on significant macroeconomic factors has actually kind of put it at the top of the emerging markets pile in terms of macroeconomic traction that the economy has gained. I think against that you also need to put what Governor said last time, that once he starts cutting, he will indeed follow it up with significant cuts as and when he sees the opportunity. And therefore the third thing, that we are actually looking at a pretty big event coming up, which is a time to kind of do a long-term structural fix for the fiscal of the country. So I think given all of this, rate cut expectations do stand. We would still expect another 0.25% going into the end of this quarter. And I think therefore for the year you will find bond prices supported and heading in the direction of 7.5.
Okay, what about rate cuts itself, Shilpa? None of the banks have moved. What's your sense? Nothing has come in this policy, but you have the lag effect of the previous cut. Do you expect base rates to fall in this quarter? Will ICICI move, you think?
So, rather than commenting about the bank, because that goes to our ALCO and things like that, but I can comment systemically, and it's fair to say that overall the rate structure in the economy has come down. You've seen wholesale deposit rates come off. We have seen retail deposit rates being reduced. So I think it's fair to say that there will be an imminent base rate cut amongst all banks. For the timing, Lata, it's important to take note of one kind of practical development that has taken place. The Reserve Bank of India has given guidelines regarding how base rates should be set. They've allowed banks to kind of change base rate guidelines once every 3 years instead of once every 5 years. And given that 3 years is kind of up and the guidelines have to be implemented, I think most banks will kind of put the two together and come out with a long-term structure for base rates. So that's really the practical aspect of when the rate cuts can happen.
Okay, so what does that mean? That means what? We wait beyond the quarter if it's going to be such a long term, or do you think another cut can nudge the bank, say if one came in April?
So directionally, I think rates have come down. So directionally, I would say that banks would be looking very, very closely at doing something with the base rates soon enough. And the guidelines are to be followed by the middle of February. So I guess post that, we could see some action from most banks.
Okay. Okay, the other announcement was that FIIs can now buy only corporate debt above 3 months, above 3 years residual maturity. How much of corporate debt is been bought at 3 years at all? My sense was that almost everything is for a shorter term. So does it mean we are going to see a lot of maturity and not too much of inflows into corporate debt?
No, I don't quite see it that way, Lata, because if you look at the world is awash with liquidity. I think Japan and the ECB have come in and put liquidity on the table, far surpassing what the US Fed has taken off. So given that situation, a country where all macros have improved will certainly stay high on the agenda of any investor. So number one point is global capital flows will see even more reason to head towards India. And therefore, the Reserve Bank's role as gatekeeper for forex flows will continue to be very, very important. And I think both steps you've seen, easing up on the outflows, which is things like LRS, as well as kind of putting a qualitative factor on the inflows. So every time there's more flow coming in, you kind of, put the hurdle up and say, okay, but now you come in beyond 3 years. So I think, the market will reassess its stand and kind of continue to come in that longer bucket. The same thing happened to government securities, if you remember, that initially the interest was much more driven into the short end of the curve, but the minute we said 3 years, the interest got diverted because fundamental reasons for coming in kind of prevailed. So I think we will continue to see, money flowing into the corporate bond sector as long as macro situation and monetary policy expectations remain.
But at the moment, how much is in above 3 years, you think, in the corporate segment?
Maybe not too much, because given a choice, most people would like to play a high-end AAA, almost government kind of debt, and as short a maturity as you can get by with, so to say.
Okay. Okay, okay. But you think that as this matures, people will be willing to come into 3 years?
I don't see why not, Lata, because you have, very good credits which are issuing in the 3-year space, which are kind of almost, PSUs which are kind of governmental in nature. At the same time, you have very good Indian private sector corporates also in that space. So I don't see at all why the demand would not get diverted into the 3-year plus categories.
And what's your sense about how the stock markets might read the whole thing? Will they read this as a neutral to hawkish stance? Should they be worried that there will not be too many cuts, or at least not too soon?
Right. See, Lata, we have to look at where the Indian economy is. I think we are at a point in time where a very long-term positive structural change can take place. And I think I'm looking very closely at the budget to give that change, because if on the back of what has happened, we actually see fundamental changes, let's say in the way subsidy is given on fertilizers, on other parts of the petroleum spectrum, if we see significant changes in tax, how it's administered, if we see significant changes in the quality of fiscal and how spends are going to happen, I think it can only put wind in the sails of the Indian economy. So I think eyes will really be on that going forward. And well, there's not been a 15-day change from the Reserve Bank of India. I don't think that's such a big deal. Eyes will be much more on budget, quality of budget.
Okay. What about the restructuring rules? Are they seminally making it easier for you to restructure NPLs? It looks like there is a conversation with SEBI so that you don't have to convert equity loans into equity at very high prices. That 6-month average may be waived. If that happens, do you think that's a very big step forward?
Lata, I can't really comment on this. It's really the CFO's area. So if you don't mind, I will skip this question.
All right. Okay, just give me an idea of where you see the 10-year bonds by the end of the year. How many rate cuts in your estimate, and therefore where will the 10-year be?
So I think we are still penciling in another 0.25% for this quarter. Now, whether that really happens post-budget or in the policy straight after, I would say it's pretty much a timing thing. So to my mind, bond yields moving down is still a very good possibility, but one has to also keep in mind that somewhere the Reserve Bank is tempering the move with things like SLR cuts as well. And I think, that's also good, because in a sense, when credit growth picks up, there will be much more money to put towards credit. But there is that little bit of tempering which is also happening. But I do see a move towards 7.5, and further, if we see further changes in inflation, either coming out of the new calculations, the meeting that happens, or the curve itself, the CPI curve itself.
But the SLR cut itself is unlikely to impact the markets at all.
So that's right, Lata. In fact, it's good timing in that sense. But it does, of course, put a little bit of tempering in terms of how it's being conducted. So, you are seeing rate cuts, but at the same time, you are also kind of seeing a little bit of future demand for bonds being calibrated. So at this point, you're absolutely correct, but one has to take a slightly medium-term view of the situation also.
All right, Shilpa Kumar, pleasure speaking with you. Thank you very much for joining us. And Sonal Varma is also with us, and at this point, let me welcome Mr. B.S. Parthasarathy of Mahindra & Mahindra as well. Mr. Parthasarathy, your key takeaways from the credit policy, are you going to see any change in the cost of money for you?
I think as an industry player, first let me say that and given the stress at the ground level in terms of growth drivers and requirement for stimulus, I would actually have preferred a rate cut at this announcement. And RBI and the government has focused for some time on the health drivers. And I think on 15 Jan, they shifted the focus to growth drivers, and I thought the trajectory would have been nice if there was a cut straight away given in this. And various things in control. The First is that inflation has been quite dovish, and so has been the control on fiscal deficit and the current account deficit. So everything being on the positive side, there was a possibility and there was a scope, I thought, to look at a further cut.
Parthasarathy, that didn't come.
But
yeah, I agree.
yeah, that didn't come, so it hasn't come. So
that has not come.
Yeah.
What is the situation now for you? No, it's a status quo, no change, or do you think the governor almost forcing FIIs to buy over 3-year residual, corporate bonds is a positive, because bonds that you float will now have more buyers from the FIIs. Do you see that as a positive?
So there are some positives. I think one is that the FPIs investing in corporate bonds with a 3-year period as a minimum one, but having the flexibility to sell it, I see that as a positive that come in. And I think this will, at one hand, avoid short-term volatility, but also will encourage more corporate bonds. So I see that as a positive. Overall, I think the overall dovish end also I see as a possibility that I hope some of this is factored in by the institutions and the banks to make the yield curve come a little bit lower. And some of it, if it flows through now, will also be a good sign. We will wait and watch, but I see some positive signals. And I also recognize the consistent stand of the RBI. No flip-flop, wait for budget, wait for some more cues, and then the next, cut we can say. And I hope I do see that in the next RBI announcement.
Will you be using any of these IRF cash-settled interest rate futures contracts for 5 and 7 year, for 13 and 15 year Government of India bonds? As well, do you trade at all in the currency futures market? All those liberalizations, are they going to benefit corporates?
First and foremost, I think that is going to deepen the overall market, and from that perspective, it is going to benefit the industry on an overall basis. As far as M&M per se is concerned, I will have to kind of have a look at this and see how do we participate. At this time, we are not majorly or in any significant manner in any currency swaps.